Hey guys, all content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. A lot of changes have been taking place lately, and now that we heard from the Fed, the narrative put by the media is quickly turning sour, which in turn might lead to further drops in the markets and economical shakedowns in the overall economy. Today we are going to discuss all these things, and we are going to start off with the latest job report. Markets took a dump today after Fed members made very discouraging remarks about both interest rates. San Francisco Fed President Mary Daly said she doesn't see interest rate cuts next year, and the Atlanta Fed President said the Fed should raise the federal funds rate to between 4% and 4.5%. These comments, once again, show that the Fed sees inflation as so disproportionately dangerous that in order to tame it, they will need a much hawkish approach. It appears that the comments from the UN demanding the Fed relaxes rates down have gone unheard, thankfully. These comments oppose the recent optimism that the markets have been enjoying. Now, the Fed funds futures market is strongly reflecting the small probability that the Fed will cut rates in 2023 after having raised them above 4%. This hope wasn't certainly not supported today and reflected in the bond market when the 2-year Treasury yield gained 4.2%, which is still below its multi-decade high of just over 4.3%. If you have been watching the news, you must have seen that the dollar has been very strong, and this presents a serious problem to the stock market. It weighs on global economic activity because it makes cross-border transactions more expensive. Also, companies see fewer earnings dollars when they translate foreign sales back into a stronger buck. Tomorrow we have the September job report, which now is forecasted to have added 250,000 jobs, making it the lowest monthly jobs gain since December of 2020. Unemployment rate is expected to hold at 3.7%. These figures are interesting because for months the government has used strong job reports as ammo to back the rhetoric that things are fine. If the job report is bad indeed, or worse than anticipated, will the government say that their perception of the economy is different, or will they now belittle the data and excuse it under something else to continue assuming that things are alright? Tomorrow holds all those answers for us. What I do know from data I have come across is that job cuts are trending higher in recent months, and that in September, businesses announced plans to cut almost 30,000 jobs, which is an increase of 46% from August and nearly 68% higher than this time last year. However, something big happened today that I didn't see many people talking about. Do you guys remember how we used to always talk about repo markets last year and constantly update on the reverse repo? The Fed's reverse repo just hit a fresh high of $2.4 trillion. This is incredibly dangerous, like alarmingly so. Remember, the Fed likes to park excess cash reserved from banks in these overnight repurchase facilities. Investors have stuck with this reliability in order to ride out the current economic uncertainty of the moment, but the problem is that the reverse repo market is not meant to serve as a stool to lean on during a market recession, and especially under the weight by which things are hanging on right now. The markets will not return to the normal bull runs that people assumed we would have reverted back. Everyone is slowly starting to realize that the bear market is here and it will be permanent for quite some time, lasting well into 2023, and now talks are predicting it to worsen through 2024 as well. Rising interest rates have seen investors significantly pull back on taking risks, which have had them go to alternative venues for lower risk and safer returns, and this is where the reverse repo markets come in. Investments like money markets typically have fixed safe returns for periods of high volatility. Reverse repo markets have been projected to rise as a way to help normalize cash supply levels. The question you guys have is, why is this bad for the markets? Well, the Fed pays an overnight rate of 3.05%, the highest yield since 2013. An increase in the reverse repo rate restricts cash supply and helps to correct inflations. But whenever financial institutions have turned to the Fed's major lending facilities in the past, this was a very clear and consistent sign of instability. For example, in the last recession of 2008, it was the strain in the repo markets that actually brought the financial panic that led to the collapse of the economy. A lot of people assume that things just went bad overnight, when in reality, repo market panic and uncertainty set everything in motion. Now ask yourself this. If the opinion of investors and economists continues to shift dramatically bearish, what is the probability that high records of repo markets will set in motion a ticking time clock before we see a new collapse? So far, things have been grindingly painful, with markets and economic data slowly but consistently deteriorating over time. But there is that one event that sets the dominoes crumbling one after another, and I think the reverse repo market could be crucial in this. And even with all these bearish economic sentiment, there are now even more red alarms popping off. Regulators' continued failure to resolve liquidity problems with U.S. Treasuries are exposing the Fed to serious challenges that I do not think they are ready to contend with. It's getting harder and harder to buy and sell Treasuries in large quantities without those trading moving the market. A measure known as market depth hit its worst level since the spring of 2020 when the Fed was forced into massive intervention. The rising risks of a global recession, geopolitical tensions and potential defaults by developing nations are shining new light into the reality that investors are simply not going to be able to rely on Treasuries as the reliable haven that they once were. There is serious and troubling deterioration in the Treasury market liquidity. When the Treasuries market broke down in March of 2020, the Fed came in like super as a buyer of last resort. Well, that is not going to happen again, as you might imagine, with a hawkish Fed. They are not only rising rates but actively shrinking the portfolio of Treasuries. You see, the Fed isn't dumb, they know very well what they are doing, they just don't want to say anything to panic people ahead of time. Guys, everything is already written in the books, there is not a lot of room for speculation as others might make it seem. If not even Treasuries are safe from this economy, nothing else will. Everything is set to fall down and devastate everything. Even the New York Fed President John Williams recently acknowledged it this week. He said that though still functioning, market liquidity is definitely lower. So when will this be over? When will we find a bottom? It's hard to say. I still believe that the housing market still has to have a big fall as well. We have seen valuations fall in these past couple weeks, but I don't think they are nearly where they should and will be. However, I think you guys know my take on this already, so I wanted to share with you the opinion of a renowned expert. Harley Bassman, a volatility expert, recently went on an interview and said equities will not find a bottom until sometime near the end of the Fed's rate hike cycle, which will not happen until next year based on policymakers' projections. Bassman is known for being the creator of Wall Street's most widely followed measure of fixed income volatility. He described the Fed as being handcuffed to headline inflation, which cannot decline quickly enough to stave off further policy tightening. Estimates are being placed that in December, we could see inflation get to 8.6%. Bassman said the Fed has effectively purchased a berth on the Titanic after it hit the iceberg and that Jerome Powell is conducting the band while the market is sending up rescue flares and we are all wondering who will find the lifeboat. He reiterated that stocks will not find a bottom until sometime near the end of the hiking cycle. He then made a very particular and alarming comment that really grabbed my attention. He said that he does not think the recession will have a collapse similar to that in bank stocks and housing prices similar to that of 2008. The business of buying and selling homes is about to come to a screeching halt. Though I understand where Bassman comes from and I thoroughly enjoyed reading and learning why he believes the market plunge will not be too bad, I disagree. However, when it comes to the business of buying and selling homes coming to a screeching halt, I kind of agree. Granted, I think Wall Street will continue buying housing as much as possible, but I think the way they have gone about it hasn't paid off in the way they wanted. I think that they are over-leveraged and that they will be hit in their pockets one last time before they perfect the way they go about this business. This halt of business actually aligns perfectly with my own theories of the housing market completely coming down. As I said, for now, they are holding strong, but we are seeing people begin to pull out of loans and agreements last minute. This could soon result in there being a shock in the market where demand drops significantly and too quickly. At that point, Wall Street and friends will have difficulty holding assets that aren't bringing in a cash, and they will either attempt to further lower their value or sprint in a rush to sell them off as a way to get some cash before the markets slim into oblivion. Back to inflation. A new report came out that showed half of U.S. families found the recent rise in consumer prices very stressful, and the vast majority of the others are worried about inflation overall. The Census Bureau conducted a survey and included questions about the soaring prices in its regular household poll. The number of respondents who have difficulty paying their bills is increasing amid rising interest rates and economic uncertainty, with more than 40% of households having a hard time covering usual expenses. This number is up from less than a third 2 years ago, which is very worrying as well. As you know, markets found it hard to continue their nonsensical rally. I don't know why investors still get their hopes high about a dovish Fed. It's almost like they are living in a dream and want to remain willfully ignorant. The Fed and Jerome Powell are continually saying they are hawkish in their stance, that they want higher rates, that they don't care about the damages it does because right now their one and sole goal is to bring inflation down, whatever the cost. People still think this is a sign to purchase and are continually getting disappointed when the market flips back. Guys, aside from meme stocks and a couple trades, I will not be buying long-term in this market. It is a fool's gambit to try to gamble a bottom when all signs point that the big dip is still off in the future. 2023 will be a big year. We could experience 2008 all over again, so make sure to have your facts aligned and your expectations correctly set. I think a huge market slump could cause MOIS as well as DR Sing all the GameStop shares. I think we are slowly moving towards a dramatic turn of events for us, but it's still going to take some time, so don't fall bait to all these influencers telling you MOIS will happen tomorrow. Continue to patiently wait as the economy collapses all on its own, hold on to your shares and be ready. Thank you all for making it to the end of the video, I appreciate your time. I hope to have brought in some wrinkles to you guys. If I don't see you tomorrow, I will see you on Monday. Come join my Discord linked in the description of the video. Until the next one, to the moon.